Hello everybody, my name's John Locke. I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that this presentation includes hypothetical computer simulated trades and/or results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name's John Locke. I'm a trading performance, wealth, and success coach with LockeInYourSuccess.com. That's L-O-C-K-E in yoursuccess.com. And myself and my team of mentors are here to help you win in the markets and in life as well. Now today, I'm here to talk to you about something called high probability options trading. High probability options trading is when we utilize option strategies to make money from the passage of time rather than depending solely on price movement to go in our direction in order to make money. Now this doesn't mean we're going to make money all the time, but it does mean we're much more likely to make money than we would otherwise. Now today we're going to be looking at an options trading strategy that I refer to as the X4 version 14. Now the X4 version 14 is what would be referred to as a conservative, market neutral, broken wing butterfly strategy, and it's a strategy that we trade on the SPX index options. This strategy requires a minimum capital level of $2,250. The example size that we're going to be showing today and demonstrating the trade with is an example size of $22,500. So it's a 10 lot position or 10 times its minimum size. With this position, we have a profit target of 11.1%, or if you correct that to the size of our trade, it would be $2,500. And we have an exit loss trigger also of 11.1% or $2,500. This particular strategy also has what we call a reduced profit target, and that happens if certain things happen within the trade as we're going along. Then we're going to kick our profit target down a little bit, and that reduced profit target would be $1,500. So let's take a look at the strategy. First of all, for those of you who might be a little bit new, this software that you're looking at on the screen right now is an analytical software called OptionNet Explorer. And what it does is it shows you a risk graph of your position. And with this, we have what we call the price matrix over here on the left. You can see we're in the SPX index. We have our options expiration cycles. In this particular trade, we're going to be dealing with monthly expiration options. Although you could use weekly expiration options, it really would make no difference in the way you trade it. Just for simplicity, with the examples, we use the monthlies. And we're going to generally start this trade 77 days to expiration. Now, sometimes at 77 days to expiration, there is a holiday, which is the case here. And that being the case, we're going to start the trade 74 days to expiration. This is what we call a longer term trade. So when we trade options, we can trade on very short term or very close to expiration. For example, we could open a trade where the options are going to expire in 10 days or 30 days or 50 days. In this case, we're going for about 77 days. So why would we want to go with options that are so far from expiration? Well, one of the reasons is when we have options that are very far from expiration, the trade tends to be much easier to manage. It tends to operate a lot slower, and it requires generally much less attention than something you put on, say, 10 days to expiration, where you're going to more likely need to monitor the market pretty much consistently during that trade period. This one here is completely the opposite. It's very hands-off, very laid back. So getting back to our matrix here, this is showing us our expiration cycle that we're trading in. In this case here, it is going to be the March 19th, 2021 expiration cycle. You'll notice the actual date up here, and that's Monday, January 4th, 2021. And on the top are our call options. The bottom contain our put options. And these numbers here are the strike levels of our options. With a broken wing butterfly, what we're going to do is we're going to sell what we call short strikes. So we're going to sell some strikes here. In the case of the X4 version 14, our short strikes are going to be approximately 40 points behind the money. So right now the current asset price is $36.95. That's approximately 3,700. So if you go 40 points under that, we're going to start with the 3660s. So we're going to sell 20 3660s. We're going to buy 60-point wings on the downside. So we're going to buy 3,600 options here. We're going to buy 10 of those, and then we're going to buy another 10 up here at 3,700. That means that all our 20 short options are covered by long options. So this is a managed risk position. If you take a look at the screen on the right here, this shows the risk profile of our position. So with this type of graph, along the bottom, we have the asset price, and along the side here, it tells you in dollars, profit and loss. We have a dot, which is our current position, or our current profit and loss at the current asset price. So right now the asset is at $36.95. This is where that dot is, $36.95 right here. And as far as the profit and loss side, we're just entering the position. After commissions and so forth, will be down slightly. So we also have this little scatter plot here, which tells us what the value of the position was during the day. And we have the curved line here, which is referred to as the T+0 line, which is going to tell us the value, or the software's estimated value of the position at any price point as of today. So for example, if today the SPX were to go up to 3,800, this is telling us that the software is projecting we're going to have a value, or a profit and loss of $802. And if the market were to go down to 3,600, this software is telling us it's projecting it would have a value, or a profit and loss of minus $930. Now, you'll notice there's another set of lines here, and that is the triangle shaped looking lines, or the sharp edge lines. This is referred to as the expiration graph, or the value of the position at any given price point of the SPX when the options are settled. So what happens here is, over time, this curved line, or the T+0 line, moves towards the expiration line, meaning that if the price were to sit here and do nothing, a situation where if you were long SPX, for example, that you would make no money. If it just sits here, you actually make money. If the price comes down a little bit, a situation where if you were long SPX options, you would lose money. We're actually gaining money here. This is our bonus scenario, as a matter of fact. And if the price goes up, we still make money. So we have a lot better chances of making money here than we would if we simply just bought the SPX. The other thing that we'll do too, if the market comes down too far, we'll actually move our options. We'll adjust or move this expiration tent so that we can make money even if the market falls even further than that. So it gives us a lot of flexibility in the ways that we make money, and it really increases the probabilities of us being profitable. So here, again, we are 74 days to expiration, January 4th, 2021. We're in this broken wing butterfly. Oh, so let me talk about the entry again a little bit. So we're going to enter a 60-40 broken wing butterfly. When we do that, we'll come down here and we will take a look at what our delta is. Now, delta is a number that represents your price movement risk in options positions. So what this delta of 8.89 is telling us, that if the market goes down $1, or the SPX goes down $1, then the software is predicting we're going to lose $8.89. If it goes up $1, the software is predicting we're going to gain $8.89. So that's what the number means. We also use this number oftentimes in these types of strategies as adjustment triggers, because once our price movement risk starts to get too high, a lot of times we'll want to bring that price movement risk into certain parameter levels. We also have something called gamma, which is how much our delta changes with each dollar of price movement. And then we have theta, which theoretically tells us how the position is going to change in value over the passage of time. You'll notice that this position is currently negative theta. A lot of the times we enter these types of positions, we want them to be positive theta. But one of the things you need to remember about this number in general is this number can kind of fool you. It's a composite of all the options in the strategy. Rest assured that if the market sat and did nothing for the next 77 days, this position would be making money. So you'll see this theta number convert itself from negative to positive as the trade goes by. Why do we have negative theta in this particular case? It's because we have a long option here. We call it put protection or hedging to the downside in case we get a really, really big down move. And again, that is part of the strategy. So what we do is we enter the strategy, or we model the strategy, I should say, without the put, and we sell these 3660s, we buy 3710s and 3600s, we check our delta. Again, that's our price movement risk. And in this case here, it's positive 15. This particular strategy doesn't allow positive 15 on entry. It only allows positive 9. So that being the case, we're going to come down and we're going to buy a put option that brings us under positive 9. And that is this option here. And that happens to pull us negative theta, but that's okay. As you'll see, the trade works out just fine. So here's where we start. So from here, we have adjustment points. So our first adjustment point is if we pull down under our short strikes at our checkpoint time. So I should also point out that we're not doing any technical analysis here, and we're not checking the market all day. We're not sitting in front of the computer. All we're doing is we're checking this position once a day. As of right now, the only reason that we would need to do anything to this position is for one of two reasons. One would be as if the asset price came down under our short strikes, which would be 3660. So we're not watching this during the day. We want to see if it's 3660 at what we call our checkpoint time. Our checkpoint time is going to be 3:30 in the afternoon Eastern time. So what we're going to do at 3:30 in the afternoon Eastern time, we're going to see if the market's under 3660. If the SPX is under 3660, well, then we're going to make an adjustment to this. We're going to what we call roll it back and reposition and start over again. To the upside or in the other direction, there's really no adjustments unless we hit negative delta and we're over these long strikes, which in this particular situation is almost never predicted to happen. Now, as time goes by, that can happen, but right now that's simply not going to happen. So realistically, unless we look at the market and the market's down under 3660, we're not going to do anything here. So that's how simple this is to manage. All right, so let's go a few days here. Okay, so if I just pop up to Friday the 8th, you see the market has gone up about $16. We're up $809. And this is what the position looks like. Again, there's no need to do anything here. There's really no need to even monitor the market other than just keep an eye, maybe put an alert in to see if the market gets under 3660. But now we're up at 3820. So I'm just going to go ahead like 10 days at a time, because the reality is that nothing happened in this position except we made money. So if we go to the 22nd here, this is what we look like. We're up $1,019. Notice we're still negative theta, but that isn't stopping us from continuing to profit with the strategy. So let's move another 2 weeks here to February 5th. So now we've been in the trade for approximately 30 days. We're now 42 days to expiration. You see our profit is $1,449. Our theta has finally turned positive here. This is what we look like on our analytical graph. You can see we're still have no chance of hitting a negative delta trigger to the upside. Our downside adjustment is still down here at 3660. We're just going to continue and move on here. So let me go another 2 weeks. At this point, we are up $1,826. Again, our theta is positive here. We still have no chance of hitting a negative delta number. We still have the same downside adjustment point. Let's keep going. Actually, before we keep going, let's talk about our exit. So we're going to exit this strategy under two conditions, actually under three conditions. So condition number one is we hit our what we call an exit loss trigger. Our exit loss trigger on this strategy is 11.1% of our planned capital, or $2,500. That wouldn't happen unless the market came all the way down to about 35.90, and we did nothing about that. In other words, we made no adjustments. We would be making adjustments, which actually gives us a lot more downside room. The other reason we would exit is if we hit our profit target of $2,500. And the third reason we'd exit, well, I guess there's four reasons to exit. The third reason we'd exit is if we went negative delta and we had to make an up adjustment and we're up over 1,500. So in this case here, we're up 1826. If by chance we went negative delta in our position, if we were still over $1,500, which we would be, then we would exit at our reduced profit target. And the last reason we exit is through time. So right now we're 28 days to expiration. The time exit is when our cycle 2 months ahead reaches 77 days to expiration, or reaches the entry point for that trade. So here we're in March, so we would be looking for May. If we go April, May. When this May is 77 days to expiration, regardless of profit and loss, that is our exit point here. So let's move ahead. We're 91 days now. That's going to be, what, another maybe 2 weeks? So let's go 2 more weeks. So here we are, 2 weeks later. You'll see our May monthly expiration cycle is 77 days to expiration. That means it's time to exit our trade. So if we go back to our options here, our March is 14 days to expiration. We have a profit of $1,974, but we're going to exit because of our time. And that would give us a profit. We take commissions and so forth out. The software is estimating that we're going to make approximately $1,933. Now, could you expire this position? You absolutely could, but according to our rule set we get out here when we go into our next trade, because we do not want to be in 3 trades at one time. That said, we are usually in 2 trades at one time. By that I mean is, as March went from 77 days to 14 days to expiration, our April passed 77 days to expiration. When April hit 77 days to expiration, we also entered a trade. So let's go back to January 29th. And on January 29th, you'll notice our April monthly expiration options are 77 days to expiration. That being the case, we're going to want to actually exit our February X4 version 14 and enter into our April X4 version 14. So in this case here, we uncheck this ignore the trades and go to our April position. Our April position is started the same way our other position was. We are at an asset price of 37.38, which is approximately 37.40. We're going to enter our short strikes 40 points under that, or at 3,700. We're going to buy the at the money options here, 40 points higher at 37.40, and then we're going to go 60 point downwing at 36.40. We're going to check our delta. If our delta is too high, which it was, let me remove the put here. You'll notice delta without the put is 13.47. We only allow a positive 9 on a position this size. So we buy some put protection here, and now we're at 8.80. You'll notice we are negative theta. Again, not a big deal. It's just part of the system. Now, in lower implied volatilities, this theta number is going to be positive on entry. In very high implied volatility, it tends to be negative. Again, you'll see that that doesn't actually matter. So this is our entry for April. If I do this 2 weeks at a time, like we did with the other one, go to February 12th. This is what we look like, right? We had a move in the marketplace. We're up $1,400, and Again, when I'm monitoring this position, I'm looking at it once a day, and I don't even have to look at the position itself unless I happen to notice that the market in this case is under $3,700. That's how simple the strategy is to manage. If I go to more weeks forward, looks like we had a bit of a pullback in the market. We did. We had a pretty big down move here, but we're still doing okay. Again, no adjustment points. Nothing to be concerned about. Let's go another couple of weeks to March 12th. Like the pressure came off to the downside. Now we're up $2,218, so everything's looking good. Let's go another couple of weeks here. Oh, the position is gone. Let's see when our exit date was. Let me go back to our other T-log. Let's go to 323, the day before exit. So 323. So here we are, 323. Let's see, we just had a 34-point down move in the SPX, but that's not really bothering us. We have a profit of 23.91, and we're 24 days to expiration. Remember, we have a time exit when June hits 77 days to expiration. This is going to exit our May cycle. But we also have a profit target of 2,500. So I'm guessing that we hit the profit target. Let's go the following day here. Let's ignore today's trades. Let's go back and look at our April position. On this day here, you can see that we exceeded our profit target number of $2,500. That being the case, we are going to close the position, and we will take our $2,500 profit for the cycle of May. And then at that point, we're also in a May cycle, which is right here. And this was entered on, looks like the 5th of March, when the May expiration options were 77 days to expiration. So let's just take a look at the 5th of March. So here we are on the 5th of March, and we have the same entry setup. You see, we entered the exact same way. We're about positive 8.8 delta in this case. We have our 60-40 broken wing butterfly. We have our put protection that brings our delta to within range, and then we're off to the races. And then from there, we'll see how May goes. But as of right now, this trade is still open. It is, however, doing fairly well. Let's take a look here. As you can see, as of right now, our May expiration trade is currently up about $1,716. So that's 2 3/4 of cycle of the X4 version 14. So some of the things I absolutely love about this strategy is, number one, it's very simple and it's very easy to manage. You can see we went through literally 2 full cycles and half of a third cycle, and all we did is we entered the trade and exited the trade, entered the trade and exited the trade, and then of course that's when we entered it. Now, does that mean we're never going to have to make adjustments? And the answer to that is no. When we get into the COVID crash, for example, we were certainly making adjustments, and with some very big down moves, we'll make some adjustments. But again, they're fairly rare, and even if we require adjustments, most of the time the strategy does very, very well. To me, having a strategy that I don't really have to monitor and makes a very good return, as you'll see when we go over the return numbers here, something like that makes me very happy. So let's take a look at the T-logs here. Our April expiration returned $2,490 on our $22,500 capital for a return of approximately 11.1%, which is just about our profit target. It's just a hair under our profit target. And then if we go to our March trade, you can see we had a profit of $1,933 for a profit of approximately, let's see, 8.6% of our $22,500 planned capital. And I mean, how much time did it take? It took me 15 minutes to enter the trade on the entry date. Again, no technical analysis. No fooling around, none of that stuff, right? We have an entry date, we have the date, we know when we're going to do it, we know the asset price, we go in, we make our entry. Occasionally we look at the position just to see we're not at profit target or we're not at a rollback point, and then we exit the trade 70, I don't know, about 65 days later or so. In the meantime, we had a trade entry in that time frame, and again, 15 minutes for trade entry, and the same type of scenario happened, no adjustments. And then, of course, we exited when it was time to exit. And like I said, that doesn't happen all the time, but it does happen probably a majority of the time. And that's one of the reasons I love the X4 version 14, this episode's winning trade. If you love what you see, I encourage you to come on over to lockinyoursuccess.com. That's LOCKE in yoursuccess.com, and discover how you too can follow along with this and many other great trading strategies during our Options Trading for Income webinars. Also, consider coming over to thewinningtrade.com. That's thewinningtrade.com. And there you can explore this and past winning trades, as well as learn about upcoming winning trades and get extra special bonus material. And then, of course, you simply have to see our Trading Performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything else you'd like to see on The Winning Trade, we'd love to hear from you. Simply comment on this video below and we'll get your questions answered for you. Thank you for joining us, and I look forward to seeing you on the next Winning Trade.